Hi everybody, Happy New Year. Jamie here, and of course it's been a little while since I've done one of these videos, but I thought this would be a really good time to kind of reach out to everybody and do it in video format to kind of talk about what a challenging year we've had, everybody has had, and what to expect from the year ahead. So let's start with a challenging year. I mean, it was a year of unprecedented. Nobody, even the Bank of Canada themselves, a year and a few months ago, they all expected that rate increases would be gradual. They didn't expect inflation to be out of control the way it was. They didn't expect the economy to continue to grow and continue to be as resilient as it was, or that the fact that they would have to do a completely unheard of consecutive increases the way they did, totaling like 4% in increases. That's never happened historically. And it's quite frankly impacted many people, and most of you, and myself included, in a very real and a very harsh way in some ways. So that begs the question, well, what can we expect from 2023? The simple answer is, I don't think anybody can be sure at this point in time, because we didn't expect last year to go the way it did based on everything we were being told constantly throughout the year. That said, we're getting a lot of mixed data right now. So we know that the Bank of Canada lost money for the first time ever in the third quarter. They lost $522 million as a result of a combined, the rate increase, things like that, which you might ask yourself, how does that cause it? But keep in mind, CMHC guarantees a lot of mortgages, and if there's defaults, that's going to impact that, in addition to bond holdings, which they had. That part's neither here nor there. The fact is that they lost money for the first time ever, and that money normally goes to help offset the federal budget, which means, what's going to happen there. Ironically, the big six banks in Canada for the same time period reported a $19.5 billion profit, up almost 25% from the previous year. So it's pretty clear that with all these rate increases, the only ones who seem to be benefiting from it are the big six banks. They're still profiting. They're profiting more than they did the previous year, which is ridiculous considering what 2021 was versus 2022. So the question is, does that lead to people deciding to do unbanking? Are they going to look to credit unions? Are they going to look to alternate lending? Are they going to look to opting for things like the Manulife One account, which functions as a line of credit, a debit account, a checking account, a mortgage, all in one, and taking more control over their finances? It may very well lead to a substantial shift in what our culture perceives as, where am I going to put my business? But let's talk about other things such as interest rates. A lot of indicators were that we were at or near the peak of interest rate increases, and I still believe that to pretty much be true. The Bank of Canada has said that they're walking a real tightrope right now between getting inflation in line and not triggering a massive recession. I think a little bit of a recession is needed to get inflation in line, but they don't want to trigger a massive one. And it's a really fine line right now. And what's bizarre about all this is the data doesn't make sense. So what we're hearing, what we're seeing, and then some of the data that's coming out really doesn't make sense. So we're seeing the bond market go like this, like it's ping-ponging almost a little bit, which affects fixed rates. So it's like fixed rates drop a little bit, then they go up, then they drop a little bit, then they go up, because the bond market is, predicting a stronger economy and a stronger dollar, and then all of a sudden not. And then it is, and then it's not. And it doesn't make sense that our economy is so resilient in the face of all of these rate increases. The other thing that really staggers the mind is the fact that we had over 100,000 new jobs created last month. And that doesn't make sense with the recession that is pending based on what the economists are telling us. Usually when there's a recession pending, you would think that means job loss, or at least not as many jobs being created, and that's not what we're seeing either. So all of this means we could actually see another increase in either January or March, based on what the spending data and the inflation data and the job data is saying, which really, I think is a little bit unexpected. A week ago, people would have said, no, for the most part, we're expecting it to stay status quo. If you look at the predictions from the banks, most banks are predicting that rates are going to basically finish somewhere around where they are now at the end of the year. We're going to see pretty much a flat year. We might see a little bit of an increase and then a little bit of a decrease or something along that lines, but essentially flat. It's really next year where they're anticipating there's going to be up to 1% drops. But again, all of that depends on how resilient our economy is. Do people continue to spend and drive inflation, or do people stop spending? We've seen the effects on the housing market. We've seen double-digit decreases year over year in terms of property values, which really means that they're normalized because they shot up by so much. They come back down to where they probably should have been had we had a normalized market. We're certainly seeing activity in the housing market. People are still out there buying houses. So it's not like that's stopped. It's not like defaults are happening. We're not seeing mortgage defaults happening. We're not seeing credit card defaults happening, which will happen before the mortgage defaults. So it's kind of a really weird year to try and predict. So here's what I can tell you, because I can't tell you a lot other than the data we're seeing isn't jiving yet. Here's what I can tell you. If you're in a variable rate mortgage, you're in the best possible mortgage you can be in right now. And the reason for that is prime minus your discount is still lower than getting locked into that fixed rate. We also know that, or we also anticipate, I can't say we know, we anticipate rates will drop over the course of the next 18 to 24 months. Which means being in a 5-year fixed rate to get out of that higher rate and into a lower rate in 2 years' time is going to trigger a pretty big penalty versus what a variable will. Whereas with the variable, you automatically benefit from the rate going down. So for those who are in variable rates or adjustable rate mortgages, you're still in the right product for you at this time from strictly a strategy standpoint. Now, that's not to say that your own personal finances haven't changed or your own personal situation has changed. If it has, and you're finding from a cash flow standpoint, you might need to do something, certainly reach out. There are new options that we didn't have, say, this time last year, or that things like an interest-only mortgage, which allows you to reduce your minimum payment to just the interest to get through the tougher times while rates are higher. The Manulife One account, which I mentioned earlier, which does their interest based on what the average balance is for the month, not based on a predicated amount. So you can lower your interest payments kind of that way. So there are options out there. But they do take a bit of discipline as well. And if you feel like you're in need of a conversation about that, certainly we can have a conversation about those options. Which kind of leads to what I'm suggesting for my commitment to you this year, and that is do not hesitate to reach out because every situation is different, and we're all feeling it in different ways. And, as many of you know, in the spring of last year, I joined a new team, and we now have 54 lenders available to us. 57 actually, sorry. 57 lenders available to us. So we have more options available than, say, what we had a year and a half ago, 2 years ago. On top of that, new products are coming out all the time. And it's an interesting time for what lenders are allowing and not allowing, and so there might have been options that weren't there before. On top of that, I want to talk about my commitment to the community at large. One of the initiatives, because we know housing affordability is at an all-time low, and I don't think we can look to the government to change that. We're not going to see prices drop to 2016 levels. We're not going to see interest rates plummet to where they were, because if they do, the prices will just shoot right back up on the houses. So really what it comes down to is not housing affordability, but housing accessibility. And that's something I'm working diligently with. In our brokerage, I've created a program along with the team that we're now reaching out to other lenders to see if we can get them on board for a product that will help first-time home buyers get into home ownership. That will maybe make things a little bit easier for them while we wait for the system to correct itself, or maybe not even waiting for the system to correct itself, because if we keep going the way it's going, the numbers don't look good. And so if that's something where you know somebody who's trying to get into home ownership, or you know somebody, you have kids, you have niece, nephew, whatever, and you're wondering how are they going to go about doing it, certainly I'm happy to talk about that. The other thing that we're seeing real attraction with is a family mortgage, and that's a situation where we're encouraging people to maybe instead of having the kids kind of contribute towards rent at home, have them contribute towards the mortgage. So put them on the mortgage, have them pay part of the mortgage payment, and build equity. And that equity can be then the down payment they use for their own home. Plus, it makes life easier a little bit on you financially. So there's a lot of different options out there, and I'm happy to talk about any of them. I just wanted to say I appreciate everybody who I've had the pleasure of working with over the last almost 7 years now. And for many of you, we've gone through not just your first mortgage, but multiple mortgages. And every step of the way, I'm here for you. I'm available at any time. I certainly pride myself on being very responsive when you have questions. I look at the big picture in terms of everything, not just interest rate, but also payment, also amortization period. What's it going to mean for overall cost of borrowing, things like that. And that commitment is unwavering to all of you, because I appreciate you so much. You allow me to be the mortgage Jedi, which is something I absolutely love and am passionate about. And I think you're going to see a lot of that passion come out this year, because I'm now shifting from just being a mortgage Jedi to a mortgage advocate. I'm going to be working to help those who otherwise are being passed by the system. That's a main focus for myself and our brokerage family this year. So certainly I wish you all a happy new year. I thank you all for the continued opportunity to work together and to provide you with mortgage solutions. And I look forward to hearing from you all soon. Have a great new year.